Hey everyone, welcome back to Corporate Decoder, the place where we break apart financial secrets to reveal the real story behind the numbers. Today we're diving into Classover Holdings Inc.'s latest filing, a company that has been making some interesting moves in the education space with a surprising twist involving digital assets. Get ready because we're about to decode it all. First off, let's set the stage. This document is a registration statement, essentially a big application to the US Securities and Exchange Commission, or the SEC, to sell more company stock. Think of it as asking permission to bring new shares into the public market. The company, Classover Holdings Inc., is looking to let certain existing shareholders sell up to a significant chunk of their Class B common stock, which is a type of stock that has one vote per S-share. So a large number of shares are being offered, but here is the key detail: we won't get any money from these sales. The money goes to the shareholders who are selling their existing shares, not to the company itself. This is common when companies want to allow early investors or founders to sell their holdings onto the public market. Now, before we get too deep, remember, this is a preliminary prospectus. It is like a draft. The company is saying, hey, this isn't final yet, and things could change. They also want to make sure you know that investing in their company involves serious risks, and you should definitely read their risk factors section. Classover sees itself as an emerging growth company and also a smaller reporting company. This usually means they get to follow some slightly easier reporting rules, allowing them to focus more on growing the business, but it can also mean less transparency for investors. Let's get into the nitty-gritty. Classover is basically an online learning platform for K-12 students. They offer live interactive courses covering all sorts of subjects, from math and science to coding and languages. Their whole idea is to make learning engaging and accessible, which sounds pretty standard for an education company these days, right? But here is where it gets really interesting. They've recently made some big moves. They went through a business combination, essentially a merger, where they combined with a special purpose acquisition company, or SPAC, called Battery Future Acquisition Corp. This is how many companies go public these days. This happened on the 4th of April, 2025. That is a pretty recent event that totally reshapes their financial picture. After this merger, they've been busy. They did a PIPE financing, which is a private investment in public equity. They sold shares and warrants to an investor for a good chunk of cash. Then they entered into an equity purchase facility agreement, allowing them to sell up to $400 million worth of stock over time. And here is the kicker. They're going to use a significant portion of that money to buy Solana tokens. Yes, you heard that right, cryptocurrency. They call this their Solana-centric digital asset treasury strategy. This is a bold move, blending education with the volatile world of digital assets. They believe Solana, a fast and scalable blockchain, can support future educational applications, and that holding these digital assets strengthens their treasury. They're not just buying, but also looking to operate Solana validators, which are like the backbone of the network, and earn rewards from staking, which is similar to earning interest. They've engaged advisors to help them navigate this crypto strategy. Now, about their core business, they offer courses aligned with the US curriculum, after-school enrichment programs like chess and coding, and even test and competition preparation. They use a teaching method called Talent, which sounds fancy, but basically emphasizes learning through tasks, academic alignment, logical thinking, evaluation, numerical skills, and targeted outcomes. Their platform is pretty advanced too. They use big data analytics and AI to personalize learning and match students with instructors. They have parent and student apps to manage schedules, track progress, and rate teachers. It all sounds very modern and tech-focused. Financially, things are still tough. Even with all these new strategies, they've incurred losses. For the 3 months ending the 30th of June 2025, they reported a net loss of over $3.8 million. That is a big jump from the previous year. Looking at revenues, their service revenue, which is their main income stream from subscriptions, decreased by 14% in the second quarter of 2025 compared to the same period in 2024. Their consulting revenue from related parties also completely disappeared. This dip in revenue, coupled with a significant increase in general and administrative expenses, especially consulting fees and regulatory costs related to the merger, led to that large net loss. Their cost of revenues actually decreased slightly, which is good, but it wasn't enough to offset the drop in revenue and the rise in other expenses. So, financially, they are still in a challenging position, especially after a whole lot of new activity following their merger and new financing deals. As of the 30th of June 2025, they had about $5.9 million in cash. That sounds like a lot, but they also have nearly $4.6 million in current liabilities and over $11 million in convertible notes, payable. That is a lot of debt, especially considering they are still making losses. They claim these funds. Along with their equity purchase facility and the convertible notes, are enough to keep them afloat for the next year. Remember that Solana investment, as of the 30th of June 2025, they had acquired about 39,878 Solana tokens, worth about $5.9 million. They also have another $2.6 million in cash for investment purposes. This is a really interesting and risky part of their strategy. The company itself acknowledges the uncertainty of regulatory developments around crypto assets and states that if Solana is deemed a security, they might have to sell it or avoid buying more to avoid being classified as an investment company itself. That is a huge regulatory tightrope they're walking. Their risk factors also highlight the volatility of Solana prices and how that could directly impact their financial results and stock price. Investing in crypto is inherently risky, and for a company trying to provide stable educational services, it is a very unconventional strategy that could pay off big or spectacularly fail. Let's take a quick look at who owns the company. Hui Luo, the CEO, holds a significant amount of Class A common stock, which carries much more voting power than Class B stock. This means Hui Luo has a huge say in how the company is run. We also see major institutional investors like Highbridge Capital Management and Pala Investments. Looking at the numbers here, it is clear that the CEO Hui Luo holds almost all the voting power at over 91%. This dual-class stock structure means that even though other shareholders own a lot of stock, the CEO's voice is the loudest by far. We also see some selling security holders who are looking to sell a portion of their shares, which is what this whole filing is about. The amounts they're selling are relatively small compared to the total shares outstanding, so it might not immediately flood the market. Now, for my take on all of this, Classover Holdings has a clear strategy to grow its education business through technology and a unique approach to course delivery. Their strengths lie in their proprietary platform, their teaching method, and strong customer retention, which is quite good. However, they are facing significant financial challenges with ongoing losses and a considerable amount of debt, especially the new convertible notes. The biggest gamble here is their dive into cryptocurrency with Solana. This could be a massive win if crypto prices soar and they can leverage the technology for educational services, or it could be a disaster if the crypto market crashes or regulators crack down. Their financial tables show a massive increase in convertible notes, payable, and warrant liabilities in the most recent period, highlighting how much they've leveraged debt and financial instruments to fund their operations and new ventures. For instance, their convertible notes payable jumped from $1.75 million at the end of 2024 to over $11 million by the 30th of June 2025. That is a huge increase in just 6 months. The company's direction is ambitious, trying to be a leader in both online education and digital asset treasury management. The risks are substantial, especially regulatory uncertainty around crypto and their path to profitability. However, if they can successfully manage these risks and execute their strategy, the potential rewards could be significant. They are definitely not afraid to take big swings. Alright, that is our breakdown of Classover's latest filing. What is your take on this company's bold move into crypto and their educational ventures? Drop your thoughts in the comments below. If you found this breakdown helpful, smash that like button and don't forget to subscribe for more deep dives into the world of corporate finance. We also have a Discord community linked in the description if you want to connect. Thanks for watching, and we'll see you next time on Corporate Decoder.